(2023). That was question 4B. So taxation of a limited company. How we tax a limited company. We did partnership, and now we are on a limited company. Okay, so we've been told that Bright Deco Limited is a company engaged in furniture and fitting making, both for local and export market. The company provided the following statement of profit and loss for the year ended 31st December 2022. So we have the first item, we have sales, a figure of 95,000, opening stock, a figure of 6 million, rounded to 1,000, that's 6,000. We have purchases, a figure of 40,000. Then we have the closing inventory, a figure of 10 million, rounded to 1,000, that is 10,000. So we have the cost of goods sold as 36 million, and gross profit is 59 million. Is gross profit taxable income or a non-taxable income? That should be a taxable income. Other incomes, we have interest from Best Way Bank. The figure is gross, that is 1,800,000, rounded to 1,000, that should be 1,800. Is that taxable or non-taxable? Remember, that is an investment income. So to get the business income, we are going to less altogether. We say that in interest from Best Way Bank, that is an investment income. So that is not a business income. However, when we are adding the other income, we are going to less it. However, when we are adding other incomes, we are going to add it. Sawa Josephine and Chepchumba. I hope, Ambuche, you are also with me. So say that interest from Best Way Bank, that is a non-taxable income, that is a non-business income. We are going to less it to get the taxable adjusted business income. Then we add it because it's an investment income that is subjected to further taxation. Then we have insurance recovery, and on that recovery we have pickup. Is that taxable or non-taxable? That is non-taxable because that is recovery on a capital expenditure. That is a recovery on a capital expenditure. Together, that is a recovery on a capital expenditure. Then we have the next is profit from the sale of marketable security. Profit from the sale of marketable security. Is that taxable or non-taxable? Not everything is taxable, Chepchumba. Profit from the sale of marketable security, that is a non-taxable income. Non-taxable income. Read your notes, and I would love you to also read your note. Profit from marketable security, that is a non-taxable income. So profit from sales of marketable security, that is a non-taxable income. Then the next we have dividends from T Cooperative Society. The figure is net, a figure of 600,000. Profit from the sale of dividends from T Cooperative Society, is that taxable or a non-taxable income? When you talk about dividends from cooperative society, remember, number one, it's an investment income. It is an investment income. Dividends from cooperative society, it's an investment income. And this investment income is subjected to further taxation. Withholding tax is not final. If you read what we've been giving from day one, Chepchumba, you have not been going through your notes, and I'm noting that. So dividends from cooperative societies other than SACCOs is a non-qualifying dividend. For this particular business, we are going to less it to get the adjusted business income. However, we are going to add it on other income because dividends from cooperative societies other than SACCOs is the withholding tax on them, which is 15%, is not final. They're still subjected to further taxation. So then we have the next type of income, that is the income from the sale of sawdust. Is that taxable or non-taxable income? That is taxable. Remember, this is furniture business. Some of the byproducts of furniture is sawdust. So the sawdust that you sell from furniture, then that is a taxable income. So that part for the income is sorted. Are we together? Is there anybody with a question? So we proceed to the expenses. So we say less expenses. Under expenses, the concept that we need to understand is the concept of allowable expense and non-allowable expenses. When you talk about allowable expenses, these are expenses that can basically be deducted against the taxable income. Then the non-allowable expenses, these expenses cannot be deducted against a taxable income. So number one is the finance charge. Is that allowable expense or a non-allowable expense? Finance charge. That is allowable expense. Asante Dennis. Number two is what we call insurance. Is insurance expense allowable or non-allowable? Insurance, that should be allowable. However, is subject to additional information. If additional information we are to be told that insurance relates to private, that insurance relates to the director, maybe private expense of the director, then that should be non-allowable. But as it stands, insurance that should be allowable expense. Then you have NHIF contribution by staff. NHIF contribution, staff. How do you treat NHIF contributions? That should be allowable, asante. Then you have tangible assets written off. How do you treat tangible assets written off? Tangible assets written off, that should be non-allowable expense. Disallowable or non-allowable. There's one that we skipped, salaries and wages. We skipped salaries and wages. How do you treat salaries and wages? Salaries and wages should be allowable. So then we have, I've said intangible assets written off, that is a non-allowable expense. Then you proceed to the next, what we call legal expenses. How do you treat legal expenses? Legal expenses can be allowable or non-allowable. So it depends on the additional information. Legal expense is non-allowable. Legal expenses can be allowable or non-allowable. Together, team. Dennis, what are you saying? If revenue in nature, then legal expenses are allowable. Are we together? That's why we say for legal expenses, that can be allowable or non-allowable. So that is subject to additional information. But if you do not have additional information, then legal expenses should be allowable. So then we go to bad debts. How do you treat bad debts? Specific is allowable, but provision, bad debts that relates to general bad debts, those should be non-allowable. However, specific is allowable. So if there's additional information, then we are told that this relates to estimated or general, then they should be non-allowable. So that is subject to additional information. However, if you have a bad debt and we do not have additional information, then we'll treat that as allowable. Together, team. So then we proceed to what we call repairs and maintenance. How do you treat repairs and maintenance? Is that allowable expense or non-allowable expense? So repairs and maintenance, that should be allowable expense. Then you have what you call, next is floating expenses. How do you treat floating expenses? Expenses that you incur in order to list shares in the stock market for a limited company. How do you treat them? That should definitely be allowable. So expenses that you incur in order to float shares or to list shares in the stock market, that should be allowable. Then you talk about pickup scrapped in an accident. That should be non-allowable because it relates to the fixed asset altogether. So pickup scrapped in an accident, that should be non-allowable. Then you have the next, deposition. How do you treat deposition? That should be non-allowable. That is mentioned. Instead of deposition, we know that in taxation, we grant what we call investment allowance. So deposition is a non-allowable expense. Then we have donation to a local church. Donation to a local church, that will be non-allowable altogether. That the local churches are not normally registered as charitable. So that should be non-allowable or disallowable. Then the next is rate and licenses. Is that allowable or non-allowable? Dennis does well, that is allowable. Then we have what we call travel directors' allowances. How do you treat directors' allowances? That should be allowable expense. Then we have traveling expenses. That should be allowable. Perfect. So then we go to pension to retired staff. How do you treat pension to retired staff? That should be allowable expense. Then we have entertainment. Entertainment, how do we go about entertainment? Allowable, unless it relates to private expenditure. Then we move to computer software purchase. Computer software purchase. So that should be non-allowable. Remember, computer is a capital expenditure. Purchase of a computer software is non-allowable. We claim investment allowance at the rate of 25%. Then we proceed to the last one, telephone expenses. How do you treat telephone expenses? That should be allowable unless there's additional information saying something contrary. So we proceed to the additional information. So number one, additional information, we are being told that directors' allowances. So when you look at the directors' allowances, include 1.2 million paid to defend one of the directors in a private legal suit. So on the item, directors' allowances, if you look at the directors' allowances, a figure of directors' allowances, if you look at that, directors' allowances, how much is it from the P&L? That should be a figure of 4 million. So 1.2 relate to private legal suit for the director. How do you treat that? 1.2 is non-allowable. We are going to add it back. So 1.2 should be non-allowable. So the 1.2 should be non-allowable. So then we proceed to the next. We have legal expense. If you look at that legal expense, a figure of 2 million comprised of the following. One is preparing a lease of 100 years. If you have a legal cost that you use to prepare a lease of 100 years, how would you go about it? That should be disallowable. If the lease is less than 99, how do you treat it? That one we are going to allow. Perfect. That should be allowable. If the lease is more than 99, then that should be disallowable as for this case. Then number two, we have collection of business debt. So legal costs that relate to customers and debtors, how do you treat it? How would you treat it? When you talk about a lease that is more than 99 years, when you have legal costs that we use to prepare a lease that is more than 99 years, then that should be allowable. However, if the lease is less than 99 years, then that legal cost should be allowable. So then we go to the next, collection of business debts. How do we treat legal cost in collection of business debt? Legal costs in relation to customers and debtors, that should be allowable. Then the second last, defense against claims of breach of trade agreements. Defense against claims of breach of trade agreements. How do you go about those ones? Claims. When you have claims against, sure. Somebody claims of breach. So when you talk about claims of breach, that should be allowable. There's a difference between contracts and agreements. So claims of this breach, that should be allowable. If you look at the last sitting, that was August 2024, claims of breach also came when you talk about alleged breach of agreement, trade agreements. When you hear about trade agreements, those should be allowable. Then we have the last one on legal fees. We have purchase of directors' private residence. Purchase of directors' private residence. Yes, non-allowable. If they're in the P&L, you add them back. So we have purchase of directors' private residence. That should be non-allowable. So if you have a legal fee that you incur to purchase a director's private residence does not relate to the activities of the bride decor. So private residence, that should be a non-allowable expense. So I proceed to the next, that is additional information number 3. 40% of entertainment expense relate to one of the director's entertainment, 40% of entertainment expense, relate to one of the director's entertainment while on a family holiday in Paris. How do you treat that? While on a holiday in Paris. So I can call it working one. I can just call it working one. That is on entertainment. Entertainment. So we're told that 40%. What is 40%? What is the figure for entertainment? That should be 1100. So what should be 40%? That should be for 40. That should be for 40. So this is private. So private, this is non-allowable. So non-allowable, non-allowable. So perfect. So tuko on that. So then we proceed to the next. We have inventory. Inventories were valued at 10% below the cost price. Inventory were valued, so that we call it working two. Working two. Under value of opening stock and closing stock. Under value of opening stock and closing stocks. Under value of the opening stock and closing stock. Together, team. Under value of the opening stock and the closing stock. So we start with the opening stock. What is the figure for the opening stock? The figure for the opening stock? Give me the figure for the opening stock. So opening stock, if you look at that, that is 6. So when you're told that we're undervalued by 10%, when you're told undervalued by 10%, it means that 6,000 was basically at 90% together. If it was undervalued at 10%, it basically implies that 6,000 was basically at 90%. Tuko pamoja. So what is the undervalue? The undervalue is 10%. Undervalue. What is it equivalent at? So we say 10% over 90 times 6,000. What is the undervalue? If an opening stock is basically undervalued, what happens? If you have, what does it do to the GP if the opening stock is undervalued? Is undervalued? So what is the correction if it does that to the GP? We deduct. So we know that number one, GP is going to increase. That is the gross profit if you undervalue. So the correction is basically to deduct. We are going to deduct. I have the figure for the closing stock. The closing stock figure is 10. The closing stock figure that is undervalued is 10. So 10,000 represents 90% because it's undervalued. So what about the undervalue, which is 10%? This, remember, is undervalue. So what is this undervalue? That should be 10 over 90, then times 10,000. So what is the figure? So get for me that undervalue. What is the figure? What is the figure? So that is 1. So what happens when we undervalue the closing stock? What does it do to the GP when we undervalue the closing stock? What does it do to the GP? So GP decreased. So what is the correction when we undervalue the closing stock? The correction is that we add back. The correction is basically that we add back. So then the next additional information, we are being told that the cost of floating shares were in respect to the private placement. Why in respect to the private placement? Where 30% of shares were sold. Number one, understand that 30% represents this flotation, which is 1.4. So, but we're being told something about this flotation, that it relates to a private flotation. So when you're told that it relates to private flotation, is it allowable or non-allowable? So we're saying that the flotation shares, a figure of 1.4, relate to what you call a private placement. Private placement. So that private placement is a non-allowable altogether. So the flotation, in this case, because of flotation, the word private placement, that makes it what you call a non-allowable. a non-allowable expense. That makes it a non-allowable expense. So then we move to the next, capital allowances. Capital allowances were agreed at 2 million. No investment allowances were claimed in respect to the software. So we need to, when you're told that there's a working 4, we can call it working, we have it as working 3. So capital allowance was agreed as a figure of 2 million. However, we do not claim for the computer software. So we can get for the computer software, we call it computer software. Computer software. So we know that what is the rate? Investment allowance for the computer. What is the rate? What is the rate? What is the rate? 25. So you get the 25% times, what was the computer software? Computer software was 300. So what is the figure for that? Give me the figure for that. So that we are going to add that. Apart from 2000, there's a 75 that was not claimed. We claimed the others, but 75 was not basically claimed. Perfect. So then we have the last one. Bad debt include, bad debt, on that bad debt, it includes an estimated default of 80,000. How do you treat estimated default? How do you treat estimated default? We treat estimated default as a non-allowable because it's based on provision. So the estimated default, we basically say that the estimated default, estimated default of 80,000 is what you call non-allowable because it's based on estimation. So that is disallowable. Is that sorted as we start this question? Is that sorted? If we are sorted, we respond with yes. Perfect. So we're being told the first thing, compute the taxable profit or loss for Bright Deco for the year ended 31st December 2022. So we say the Bright Deco Limited, Bright Deco, taxable profit or loss for 2022. So we have that. Then you say that profit, we start with which method are we going to use in this particular question? So then we go to our profit provided. Profit, we just say accounting profit provided. What is accounting profit basically that is provided in this particular question? How much is it? How much is that? So that is 19. So we have 19, we have a figure of 19,800,000. So that is, then we say we add back. What do we add back? Very sensitive. We need to know that we're adding back what you call non-allowable expenses in P&L, non-allowable expenses in the P&L, comma, and you say taxable income not in P&L. So we had non-allowable expenses in the P&L and taxable income in the P&L. And the good thing is that we have analyzed the question. If you look at these expenses, we have the first one, intangible. We call it intangible assets written off. How much was that intangible assets written off? You give Molimo because we've analyzed. That should be 114. And then we have the next, what you call private flotation expenses. So that all flotation expenses should be non-allowable. Private flotation of expenses, that should be 1,800, 400. We also have pickup scrapped in an accident. Pickup We have analyzed all these things, scrapped in an accident. How much is that? Pickup scrapped in an accident. So that should be a figure. Now that makes sense if all of. So we have the next is depreciation. Depreciation. What is the figure for the depreciation? Depreciation should be 34. Depreciation is 34. What about donation to local church? We have donation to local church. Donation to local church ni ngapi? The figure for donation, we say that is non-allowable. So as we rotate the camera to this other side, still on the non-allowable, donation to the local church. On that item, we also have the next is computer software purchase. Computer software purchase. So that was 300, non-allowable. So additional information, we do not have. Additional, we say private legal suit. Additional information 1, private legal suit. Legal suit for director. The figure, how much was private legal suit for the director? The bigger work has been done, and that is analyzing that private legal suit. So that was additional information number 1. Then we have additional information number 2. We had preparing lease of 100 years. Lease of 100 years. Preparing the lease of 100 years. That should be 800. Then you had the last one, purchase of director's private residence. Purchase. The other ones will allow purchase of director's private residence. That should be 200. Private entertainment. So remember, it was 40%. That was for 40. That was private entertainment. Then we had the next, what you call, what you should add back is closing stock understated. We said that the closing stock understated. What is the closing stock understated? So that is 1. That's okay. Then we go to estimated default. What you call estimated default in bad debt. Bad debt. That should be 80. So get for me what you're adding back. Sum it for me. 13, perfect. So we have 13, 131. Then you say we're less, non-taxable, operating incomes in P&L, investment incomes in P&L, allowable, what you call allowable, expenses not in P&L. Allowable expenses not in the P&L. So we go to the incomes that we have up there. So number 1, non-allowable expenses or investment incomes that are in the P&L. We have interest from Bestway Bank. Interest from Bestway Bank. How much is that interest from Bestway Bank? That's an investment income. So the next we had what you call insurance recovery. Pickup. That is non-taxable. Insurance recovery. And then we have the pickup. That is 1,000. We add it because it relates to capital expense. Then we have the next what you call profit from sale of marketable security. Profit from sale of marketable securities. How much is the profit from sale of marketable security? That is an untaxable income. How much is it? That is 900. Together, 900. Then we had do we have any other income? That is dividends from cooperative society. Dividends from T cooperative society. We say T cooperative society. Dividends from T cooperative society. The figure is 600. That was what was deducted. So we proceed to this other end. So next is we say that we proceed to this. We say that the next should be investment allowance. Investment allowances. How much is the investment allowances? That is allowable expense not included. How much was it? It was agreed to be 2,000. Computer software. That is investment allowance. That is what we got, 25% times 300. We got this to be 75. We got that to be 75. Together. Are we together? Then we have opening stock. Opening stock. Understated. Understated. That was 667. So how much should we less? So add this total. 1,800, the total of what we need to. 1,800, 1,900, 600, and then we come to this side, 2,000, 75, 667. Gilbert already has it, that is 70, 40, 42. So we have what you call adjusted business profit. What is adjusted business profit? So the profit that we are adjusting, 19,800 plus 13,131, then minus 70,42. So that is adjusted. Correct, 25,889. Then we add. Remember, this is not a partnership where we take other investment income to the income allocation schedule, but we add other taxable investment income. Add other taxable investment income. What are other taxable investment income? Investment incomes that are basically subjected to further taxation. Which one are they? Interest. Number one is interest from Bestway Bank. Interest from Bestway. We remember we give it at gross. What is the gross figure? Interest from Bestway Bank. I want to ask a question. What about interest that an individual receives from a bank? Interest that an individual basically receives from a bank. How do we treat it? So interest that an individual receives from a bank is a qualifying interest. If an individual receives interest from a bank or insurance company, that is qualifying, meaning the 15% withholding tax is final. However, if a limited company receives an interest from a bank, that is non-qualifying. We're still subject to further taxation. Then we have dividends from cooperative society. Dividends from T cooperative society. Dividends from T cooperative society. Dividends from T cooperative society. Somebody say something. So then we go to dividends received from cooperative society. Both individuals and limited company, when they receive dividends from cooperative societies other than SACCOs, those are non-qualifying dividends. The 15% withholding tax is not final, meaning we still subject them to further taxation. How much was received? Remember, we take it to gross. We give it at gross. The figure was net. So gross is going to be 100% over 85 times 600 in order to get the gross. What is the gross? 706. Perfect. So then we get total taxable income. give me the total taxable income. 28,395. So part 1 is done. How many marks was that? Just to teach this. I normally love teaching students this because some students concentrate on getting answers. This is for the exam purpose. I want to distribute those marks. How many marks was that? That was 8 marks. Look up. 1, 2, 3. Entries. Remember, concentrate on entries. 4, 5. Remember, I'm concentrating for the exam purpose. I'm concentrating on entries. These ones are not. These answers are not very much important. So then we get to this. That is 5, 6, 7, 8, 9, 10, 11, 12. That is 12. 13, 14, 15, 16, 16, 17, 18, 19, 20, 21, 21. We have 21 entries. And how many marks do we have? We're saying that a half times, in order to get 8, any 16 entries. So look up, we have 21. We have 21 entries altogether. So in this question, you only need 16 entries altogether. So it's not a must that you get these answers in order to score. And that's why I insist that for my students, let nobody get less than 75% of the entries. So get to the second part. So the second part of it, we're being told that compute the tax payable. Compute the tax payable. So we have tax payable. Look up tax payable. How do you tax companies? How do we tax company? We say that resident company we tax at 30% and the non-resident company we tax at 37.5. So this is a resident company. So that we're going to have 30% of the total taxable income. What is the total taxable income? That should be 28,395. So what is that? 30% of that? 85, 1. So what is the concept? The concept is not the answer. Look up. If somebody is marking this, the concept is 30%. Mati tunaelewana. If I was a student and I got 10,500, I use what I have. So you're not going to be marked because you have this. Once the student has 30% of whatever he has, that should give you that. Is that okay? Because not many. Then you say less withholding taxes. Less withholding taxes. So number 1, there is withholding on best way. What do you call best way? Best way bank. There's a withholding on best way bank, and that withholding is 15%. So 15% times 1,800. How much is that withholding? Get for me that withholding on that investment income. Nipatie. Nigapi 270. So then we also less withholding tax, which is 15% on T, we call it T cooperative society. 15 over 100, just say 15% times 706. What is that? 15% of 706. That is 106. So net tax payable. What do you call net tax payable? What is the net tax payable? So we have the answer. So the first is this, and this. So how many marks are those? 2. So any 3 entries. Any 2 entries gives it 2 marks. So if you have this and this, you have it. If you show the 30%, you multiply whatever you have, that's an entry, this and will give you that all marks. So I want to go to taxation. Taxation of sole proprietorship. Taxation of a sole trader. So the question is, I'm giving you the small notes on that. We don't need to write. November 2016, question 5C.